JEPI, or JEPI, is the JP Morgan Equity Premium Income ETF, and JEPQ, or JEPQ, is JP Morgan NASDAQ Equity Premium Income ETF. And they're both income-focused ETFs that use options to generate regular income. But they differ in their underlying index exposure, and more importantly, their income potential. They have crazy high dividends, like 3 or 4 times as big as something like SCHD or VYM. And when you use these correctly, you could definitely be able to retire early with passive income forever. In this video, I'm going to go over features of both JEPI and JEPQ so that you can take a look at what I'm seeing and make a very good decision for your portfolio. And then I'm going to let you know exactly how to invest in these and where specifically they should be invested within your entire portfolio. And if you invest in these or any other covered call ETFs, please write those down in the comment section down below and let me know why you like them best. My name is Nolan Govea, my students call me Professor G, and I made this channel to make investing simplified. So let's dive in. Number 1, this is the main reason why people would even choose to invest in these, and this is the cash flow, or their dividends. Both JEPI and JEPQ have incredibly high dividends, which make them super attractive for all people looking for that passive income. JEPI generally offers a yield around 7 to 9% depending on market conditions. Right now it has a 7.52% 12-month rolling dividend yield. Its broader sector exposure can make these payments more stable. JEPQ, the yield tends to be a bit higher than JEPI, often around 10% or more, due to added volatility in tech stocks. This comes with potentially higher price swings. JEPQ has a 10.06% 12-month rolling dividend yield. Taken together, this gives an investor an 8.54% 12-month rolling dividend yield. Oh, and did I mention these are monthly dividend payers, which means that you get paid every single month, not quarterly like SCHD or VYM. Not too shabby. Number 2 is all about the underlying exposure. JEPI tracks the S&P 500, representing a diversified selection of large cap US companies across all sectors. It has a more balanced sector distribution, which gives it a lower risk profile and broader exposure across the US market. JEPQ tracks the NASDAQ 100, so it's concentrated in large cap, non-financial US companies, primarily in technology. With that heavier exposure to technology, this means higher growth potential, but then also higher volatility when compared to JEPI. Number 3, this is how we get a little bit deeper and try to really figure out how are they able to provide such a high dividend and keep that sustainable for the many years to come. Both ETFs use a covered call strategy to be able to generate monthly income. This involves selling call options on their holdings, which provides additional income, but it also brings down the possibility of that share price appreciation. So if you look at these ETFs, they're not growing like crazy. If the S&P 500 is up 20%, JEPI, just because it has the underlying index of the S&P 500, isn't also going to be up 20%. That's kind of where you're getting some of that cash flow from, is it's at the price or at the cost of that higher appreciation or possible higher appreciation. JEPI has a slightly more conservative income strategy because of its diversified base, meaning it tends to have more stable income, but with lower growth potential. JEPQ potentially higher income due to its tech-heavy portfolio, which tends to be more volatile. Volatility can lead to higher premiums when selling options. One of my subscribers helped with the assist here, so thank you. Since JEPQ only writes covered calls on about half of the portfolio, some of your distributions are going to show up on your yearly broker statement as qualified dividends. The other half will be taxed at the higher regular income tax level. JEPI does about the same, but a higher amount of the distribution are qualified dividends. So basically, JEPQ is going to incur a little bit higher of taxes at the end of the year, so definitely keep that in mind. And since these are generating such high dividends, 7 to 12%, you want to keep that in mind when you're thinking about where to put this into your portfolio, and we'll talk about that in a little bit. But speaking of income generation strategy, I have a treat for those of you that are looking for some passive income in a very solid way. We all want a little bit more cash at the end of the month, so let me thank and introduce the sponsor of this video, Build Your Store AI. Starting an online business has never been easier. With no upfront costs, minimal investment, and a manageable time commitment, it's an ideal side hustle that you can scale over time. Whether you're looking to supplement your income or eventually transition to full-time entrepreneurship, an online business offers flexibility and significant growth potential. And this is how easy it is to set all of this up. First, you'll sign up by registering on the Build Your Store AI platform, and then you'll pick a niche that aligns with your interests and market demand. From there, you'll just opt for the basic Shopify plan to have initial low costs, starting with $1 per month for the first 3 months. Build Your Store AI provides clear, easy to follow steps to set up your Shopify store. With the click of a button, the Build Your Store AI creates your unique Shopify store, then you register for Auto DS to streamline your product sourcing and order fulfillment. This basically just means that you literally don't have to do any work when someone buys from your store. It'll all be taken care of and you don't have to lift a finger. AutoDS is very easy to use, and then you can launch your store and start selling stuff. And just like that, you have a solid online store, exactly like this one, that looks professional and works extremely well. Click the link down in the description to get your free AI store builder today. Okay, so now I'm going to give you 3 more comparisons of JEPI and JEPQ and then explain how they should be invested within your portfolio. So this next section in number 4 is all about performance and volatility. JEPI definitely has a little bit lower volatility since its holdings are in the S&P 500. It's more resilient during market downturns, so it might not fall as much during corrections. JEPQ has higher volatility since it does track the NASDAQ 100, which means that it can go up a little bit higher, but also down, especially during market downturns or recessions or anything bad in the market. One big thing to note here for both of them is that these funds haven't been around for a very long time, which is why I've been a little bit apprehensive and at least cautious when my private financial coaching clients ask me about where it should go in their portfolio or if it's a good one for their portfolio. I tend to like funds that have been around for a little bit longer so that I can see the data and see how it reacts to different market conditions. JEPI has been around since 2020, so about 4 years, while JEPQ has only been around since 2022, so only about 2 years. JEPI is currently priced at $59.43 and is up 7.82% year to date. JEPQ is currently priced at $55.95 and is up 12.87% year to date. These are nice little price appreciation hikes along with those huge dividends. Number 5, very important to check into whenever we're looking at ETFs is the expense ratio. JEPI has an expense ratio of 0.35%, which is relatively low for an income-focused ETF with an options overlay. JEPQ also has an expense ratio of 0.35%, making them equal in cost. Number 6, suitability and long-term considerations. JEPI is suitable for income-focused investors looking for high, stable dividends with lower volatility and broader market exposure. JEPQ would be better for income investors who are comfortable with more technology exposure and can tolerate higher volatility for potentially higher income. So in summary, and then I'm going to tell you where to put them in your portfolio, JEPI has a broader diversification across sectors. It's less volatile with a stable income stream. JEPQ is technology focused with higher income potential but more volatility. JEPI is a strong choice for conservative income-seeking investors, while JEPQ suits those willing to embrace some volatility in exchange for higher income potential. So how to invest in these and where do they belong in your portfolio? The big thing to consider here is the dividends. There's a huge pro here, but also a very big con. Pro is obviously that cash flow. Those dividends, 7 to 12%, are definitely going to be something that you could easily live off of, especially once you start accruing enough money and that you're able to actually have something where the dividends are pulling from. The con is the dividend as well, but namely the tax associated with that dividend, especially since part of that tax comes in the form of regular income tax, not qualified dividend income tax. And so because of that, you're almost getting taxed double there. There's really only two ways to invest in these, in my opinion. The first way would be that you already have all of the capital right now. Say you need about $60,000 per year to pay for living expenses. Getting an average dividend between the two of about 8.5%, you'd only need a little over $700,000 total invested. Now, if it was me though, I'd want something with a combination for my cash flow portion of the portfolio to have something a little bit safer, a little bit less volatile, along with JEPI or JEPQ. So I'd rather have about $1 million invested with half in SCHD and half in the JEPI JEPQ combo. $500,000 in SCHD would produce a dividend of about $17,500, and $500,000 in the JEP combo would produce about $42,500, giving you that $60,000 and keeping you safer in the process. The other way that I'd ever be comfortable investing in JEPI or JEPQ is only in the Roth account. Since in the Roth account your dividends grow tax-free, and eventually you can take withdrawals tax-free, these would be a superpower within the Roth account. So if one has a bunch built up in the Roth account and is nearing that retirement age after age 59 and a half, I could definitely see that being a very solid strategy to be able to get 7 to 12% in dividends off of however much you have in the Roth. Then you don't have to sell any shares, you can just live off of that dividend and it comes monthly. That's very nice for those of you that want to get rid of an actual job or paycheck and have that supplement your income. I don't really like adding JEPI or JEPQ to one's portfolio in the build stage. So if you're 20, 30, 40 years old and you're still building up the entire portfolio, I think there's better ways to get that money higher, and then later on you can sell out of that and buy into the JEPI, JEPQ, and SCHD possible whole combo there, and then at that point take advantage of the dividends. If you start right now with a smaller portfolio and you have JEPI or JEPQ in there, as it's growing you're going to see a lot of tax drag, especially if this is in the brokerage account, which is why I really don't like JEPI or JEPQ in anything other than a retirement account, and specifically the Roth IRA. There's just so many different strategies and so many different ways to get to where exactly you need to get to, and it's based off of you individually, so it's kind of hard to give just general thoughts here. But if you like what you heard in this video and you want to talk through some strategies with me, send me an email at ProfessorG.invest@gmail.com and we can set up a coaching call. I do one-on-one coaching calls over Zoom where we can look through your portfolio and strategize the best option to get you invested right. In full transparency, I don't invest in either JEPI or JEPQ at this time, but I would definitely be thinking about it if I was much closer to retirement and within my Roth IRA specifically. There's a lot of different types of cash flow strategies, so let's figure out the best one for you. Watch either of these two videos to keep you going strong in your investing journey, and remember to keep investing simplified.